Okay, now, we talked about the best put to ensure your position. A previous webinar that's available in the archives and of course on YouTube. But the proper structure of a radioactive trade is rather than go cheap with an out-of-the-money near-term put option, we use a structure that puts time on our side to control risk to single digits properly by just going slightly in the money and further out in time. This, of course, gives us that proper limited risk structure, and we showed the pros and cons and the benefits of using this approach of a different form of a married put as opposed to the standard form you might already be using or have read about at other websites or at your broker. Well, what's next in this radioactive structure? Do we simply just expect the stock to go up in price? No, that's our goal, that's our expectation, but we know that that doesn't always happen. Do I just leave the position alone, and then as I get closer to expiration, 4 or 5 months down the road, check it at that time? No, I'm going to be actively trading inside a properly nested limited risk structure. But do I try to leg in and out? Once I open the proper structure, do I sell the stock when it moves up? Or do I just sell the put when the stock is down, then continue to buy back in and buy back out? No, not really. We're going to use other forms and other structures to do that to keep the controlled risk in place and to keep our upside potential profit increasing or moving up to take advantage of that while rewarding ourselves in the proper position. This is where the income methods come in. In radioactive trading, we teach 12 different adjustments that can be used inside of the structure. What is the goal of the 12 different income methods? Well, there's several different goals that we have for those income methods. One, of course, is to simply generate income, just as you're probably doing now with other trades and other structures in your portfolio, but we're doing it still in a nested, protected position where we can't get hurt. The income methods, we want to lower the risk, lower the cost basis on the trade, which will also help us increase the profits, whether the stock moves up or down or maybe stagnates. And of course, we want to look at potentially bulletproofing the position. And what that means is that after a couple of adjustments or a few adjustments, I may have lowered the risk completely to where I have no risk to the downside, going into earnings or going into a volatile market, and still have the potential for further upside profit. The desired outcome is to meet our trading goals, of course, but also to be able to take that low-risk trade we started off with and potentially make it a no-risk trade without hurting the upside profits too much. So as you can see, we start off with initial married put, low-risk trade. As we make an adjustment or an income method, we're going to lower the risk and we're going to lower the break even on the total position. And then eventually we can get to step number 3 where there's no risk on the trade and we still have unlimited potential upside. But why are there 12 different income methods? Why not just a simple structure of buy the stock, protect it with a put, and just look to sell the call and manage it that way? Well, that works in a certain type of market conditions, but as we all know, there are various market conditions that come up at different times. Some of the 12 income methods are best used when the stock moves up in price. Some we're going to use if the stock enters a stagnating period, where we're not seeing much movement or maybe just plus or minus 2 or 3%. Some are used if the stock falls, but we think it's going to recover just due to market weakness and we still selected a strong stock. We can put ourselves in a better positions to take advantage of more upside movement. And some income methods will allow us actually to profit in both directions, whether we're right or whether we're wrong, and the stock continues to move down. Of course, why are there only 12, you might be asking as well? Well, everyone wants to improve an idea, or everyone knows better. And that's the right approach to take. You see a new trading concept, you see a new idea, you have your own knowledge of what's worked for you, what you've done in your account, what has and has not worked, and you want to improve it. You want to see something that says, now wait a minute, I see this structure, I think I can make it better. And those are the right questions to ask, and that is the right approach. but occasionally you might get handcuffed or do the wrong thing. It's a question that came to me via email a few weeks ago. I said, hey Mike, I saw your webinar on married puts. I entered it with a bull put credit spread. This is one of the income methods that you talk about, right? This is an investor who does it on the blueprint, just saw a few webinars on protecting risk. Well, the answer to that question is no. The married put by itself, the radioactive structure, is a bullish position. I have the expectation that the stock will move up in price. Doesn't always happen. That's why I have the controlled risk in place. A bull put credit spread is a bullish position where you'll make a reasonable income if the stock stays the same or moves up in price. So why not combine the two? Well, it's because it might work, but it's not one of the 12 income methods. And the reason why is that it doesn't satisfy the simple roles of an income method. Would a bull put credit spread in the nested structure of a married put generate income? Absolutely. We're going to sell just slightly out of the money put and buy a lower put. We're going to generate a credit that's taken into our account. It's going to reduce the cost basis and generate income. Does it lower the risk and the cost basis on the trade? It does lower the cost basis, but it doesn't lower the risk on the position. It actually is going to increase the risk on the position. And could it potentially bulletproof the position over time? It could, but it's going to take a long time to be able to do that. All right, well, let's look at an example. One of the most recent trades entered in the Fusion account at RadioActive Trading for Fusion subscribers. Ernie opened on 10/26. Fusion subscribers can follow Ernie's trades and my trades. So just about 4 days ago, Ernie bought 100 shares of Ollie's Bargain Outlets at 87.72. Following the radioactive structure, he bought an April 90 put, about 175 days out in time, slightly in the money, and he paid a price of $9.50. So his total invested in the position is $97.22. He's guaranteed, even if Ollie fell to $50 per share, to get $90 back. So it's a maximum risk, just the time value of the put, of $7.22 or 7.4% of the total investment. Now, as of this morning, of course, we see that Ollie is trading at 89.55. There it is. Okay, I was waiting for that. A question came in, a comment came in and said, well, with that cost basis, you're not going to make any money until the stock goes up to the break even at 97.22. Oh, sorry. And that's correct. If Ernie holds this position all the way to April expiration, makes no adjustments, accepts no dividends, if Ollie paid a dividend, you're right. He'd need the stock to be trading at 97.22. But that is not the goal of a radioactive trade. We're not planning on holding the position all the way to expiration and just hoping it goes up. Ollie's up $1.83, moved up to 89.55 as of this morning. The put did decline, but it dropped from 950 to 880. We still have several months of time premium remaining on the put, so you've only lost 70 cents. So the position is still at a profit. But if you wanted to add a bull put credit spread to this nested structure, what might we do? Well, with Ollie at 89.55, one might consider selling to open the November 85 put at $1.30. Now at the same time, you could buy a November 80 put for 55 cents. So we're going to generate a credit of 75 cents for about a 20-day trade. Now, remember the true risk was 7.22, the time value, the at-risk amount on the Ollie radioactive trade. Generating 75 cents for about a 1-month trade is only 1/10 of the total at risk. So it might take you 10 right cycles to be able to pay off that and bulletproof the position with this approach. But we did generate 75 cents. We are going to lower the cost basis on the total nested structure, and the new at risk should be 647. I started with 722, collect 75 cents. I should drop that down to 647 as the maximum risk on this trade, right? Well, the bull put by itself has a potential return of 17.6% as a leveraged trade. It has a probability of 71% of remaining above 85 at November expiration, where both puts would expire worthless, you'd keep the net credit. But it carries a margin requirement of 5 points, or 425 is the true risk just on the bull put credit spread. You've got to put up the 5 points in the situation to cover the drop between 85 to 80 if the stock did fall suddenly. But combining everything together, the 100 shares of stock at 87.72, protecting it with that April 90 put for 950, so you only have a risk of 7.4%, and adding the bull put does generate income. It did lower our total cost basis, but the risk actually increases. Why? Because I still have to put up the 5 points, and if Ali falls to 80, I'm losing what I would lose on the married put plus that extra 425 in the bull put spread. This takes our risk up to 11.3%, not quite double what we started with, but not the direction I want to go if we experience another 20 to 30 days like we've seen in the last month. And as I mentioned, we could bulletproof with this adjustment, but it might take 10 months. We're only protected to April, which is 5 months away. So this is not one of the 12 income methods. But we do use other riskless spread trades, credit spreads, ratio spreads, butterflies, and even condors inside the nested structure, which don't really increase the risk and can actually still leave the upside open. Many of the 12 income methods we use in this married put structure are strategies that you're already using. And a few of them are likely quite obvious. In fact, in that free white paper, The Sketch, that you can get at RadioActiveTrading.com, we show income method number 1 already. You can see one of those there. And you've probably already figured it out. As an options trader, whether you're just starting, whether you just applied to trade options, or you've been trading for an extended time with different strategies, you look at a stock structure protected by the proper put, and you say, well, Mike, let's just sell a call on Ollie right now to generate income. We're going to lower the risk. It could easily bulletproof it over time. And you're right, selling a call, sort of as a covered call, but to create a collar, is income method number 1. It's one of the 12 income methods. But you don't want to do it wrong. There's a right way and a wrong way to do it, which might be different from what you're already familiar with trading covered calls. So let's look at Ernie's Ollie position, and let's generate income right now. Looking at Ollie, the best premium would probably be the November 90 call at 295, which is the midpoint. This generates about 40% against the initial risk of $7.22, and that's good. That's what I want to look for. So here we can sell to open the November 90 call today for about $2.95. What happens? You take in income. It's perfect. You're going to lower the cost basis on the position down to 94.27 from that 97.22. But is the structure really what we want now? It solves most of the rules and the roles of an income method, but now we see an issue where we have a capped gain on the position where the stock's trading right at the peak, right at the maximum profit. We've now also set ourselves up with 2 ways to lose. If the stock continues to move up as I expect, giving too much back to the market because of the obligation of the short call at 90. Any further gains on the stock are sort of hedged out. We don't have a positive delta anymore as we did with just the standard married put structure, because all of that delta we would gain on the stock, the one delta, is now countered by the short call. Of course, there's ways to adjust this, and that's talked about in the blueprint as well. But this might not be the proper structure that we want for the position. That is income method number 1, is selling a call. But remember that when we open a radioactive trade from the beginning, it's because we selected a stock that we have an expectation might move up 3 to 6% in the first 20 to 40 days. That would put Ollie at around 92.10, 92.15. That's still well within the profit zone with this income method number one structure we just showed. But what would happen? Well, if the stock's at 92.10 around November expiration, I'm going to have to buy that call back for 210 if I want to stay in the trade. I'm away from that max peak profit of around 4% we gave back to the market. So I sold the call for 295. It would cost me 210 to buy back. I'm only really taking 85 cents. That's okay, but it's still about just 1/9 of the original at risk. I'm getting ahead, but not nearly as much as I wanted to. The structure of this income method number one on Ollie is a decent income method. If and only if I felt the stock was going to stay right around 90, maybe between $89 and $91 per share. If my expectation is the stock might continue up and go to 92, 93, or 94, that's not a good adjustment, taking a look at the profit and loss chart. There are do's and don'ts for each income method that we discussed, and it's what we call the SIGA model. When I reach a point where I want to decide if it is time to do an adjustment on one of my radioactive trades, I consider the SIGA model. What are the current conditions? What are my expectations going forward? And what are my goals for the trade? That may come down to generating income right now, longer-term growth, or a certain target that I might have. The answers to those three, or the sentiments of those three, are going to help determine my action. And that's the SIGA model. It helps me determine which income method is best for the current position I'm in based on my expectations and my goals moving forward. Now let's look at another structure. Same stock, but on October 26th, when Ernie opened the Ollie RPM, he could have also bought shares of stock at 87.72 and bought the April 95 put for 12.10. This would be a total cost basis of $99.82 with a guaranteed exit of $95. So the maximum risk now is only $482 or 4.8% of what he has invested. It's still within the range of a decent radioactive trade. I want to keep my risk between about 3.5% to 8%. So both positions match the requirements of a good radioactive trade. It has a controlled risk. It still has unlimited upside. But in this case, 4 days later, with the stock trading right around $89, moved up a couple points as Ernie expected, that 183 that we saw, I say to myself, okay, here I am in this structure. I want to sell some premium and reduce my risk. Even though I started off with a very low risk to begin with, why don't I sell that same 90 call right now? Well, that is a problem. That is the wrong thing to do. We do generate 295 against the position. It's almost half. It's a little bit more than half of that initial at-risk we saw in the trade. But remember, in the structure itself, we would have gotten into Ollie and purchased the put because we expected the stock to move up. If I generated 295 by selling this call, and I'd started off with an initial risk of 482, how is my new risk here at 687 or 7.1%? It's because it's to the upside in the direction I thought the stock was going to go. I had an investment of $99.82 with a stock and put combination. I sold a 90 call for $295, which does reduce the risk down to about 183 or 190 to the downside. So yes, if the stock fell now, that risk would be reduced by 295 in the worst case scenario to the downside. But now to the upside, if the stock's just trading at 97 or 98, I get back into a loss zone. I now have two ways to lose, and it's in the direction that I thought the stock was going to go. I've increased the risk to the upside because if this stock really gaps up from unexpected news, what happens? The put declines because the stock's moving up. The positive delta on the stock is countered by the short-term call because as it moves up, this delta is going to increase in expiration, That delta of that short call is just going to go to 1 if it's in the money. So we don't get any more positive gain to the upside in this structure. It's not really what I want to look for with an income method number 1. Okay, so you know how to sell a call. You've probably been trading covered calls. You've probably been doing other adjustments. You've probably been trading collars. You know how to sell a call and what the risk reward looks like. If I bought Ollie at 89.50 and sold the 90 call for 295, if the stock's anywhere above 90, I'm probably going to make close to 3.5% for that 20-day trade. But this, remember, this is a complete structure. It's 3 working legs now. If you sell the call too soon and at the wrong strike price, you can get into trouble. For income method number 1, part of the SIGA model is that when using it, I want to generate at least 1/3 of the risk I have in the position. Well, that November 90 call solved it for both structures we saw, the April 90 radioactive trade and the April 95 if that was selected. The call should always be at or above the put strike price. That's why when you open a married put, you don't want to sell a call right away, because the call that's probably going to give you the right premium is below the put strike price, too far below your cost basis, and you can get into trouble on the upside if the stock moves in your desired direction. And I never want to increase my risk in the direction that I want the stock to go. Meaning that if I entered Ollie as a radioactive trade, it's because I expected the stock to move up. And it's funny to me personally because a lot of investors, when they first are introduced to this technique, they say, well, why are you buying the put? You're trading against yourself. You're looking for a bullish stock and you're buying a bearish instrument against it. Why would you trade against yourself? No, I'm insuring a position that represents a fair amount of value in my portfolio. I'm adding insurance to it. But yes, I am still bullish. If I sell the call too soon, even though I generate income, now I'm trading against myself because, as we saw, we put ourselves in a structure where I can lose in the direction I thought the stock was going to go initially. That's trading against yourself, trying to force an income method, generate premium too soon, and doing it at the wrong price. That is now trading against yourself. I don't see buying a stock and buying a put as trading against myself. I see it as protecting an investment. But I do see trying to force something too soon because you feel that you have to generate income, or you want to take advantage of weekly options and just try to sell week by week by week. You're putting yourself in a structure where now you are trading against yourself because you could lose in the direction that you expected the stock to go. Now that is how we apply the SIGA model. And the SIGA model is discussed and written out for every one of the 12 different income methods and discussed in the blueprint. And you can watch any of these free webinars and say, okay, I get it now. You're adding some insurance to the position, and now I'm just going to start generating income. And then you might call me up in 2 weeks because you're losing on a position where you tried to force an income method right away. The stock matched your expectations, but now you're not making money on the position because it was done incorrectly. That's the danger, and that's the risk of just seeing the structure and saying, hey, it's great to limit risk, let me go try that, but now let me do it this way as I have been doing it with just covered calls or in the money covered calls. You're setting yourself up for potentially a loss in the direction you wanted the stock to go. All right, but let's take other examples. We're going to navigate over to power options. I'm going to quickly take a look at how one can find a new radioactive trade. We're going to look at why income method number 1 is not done right away. I'm going to show you briefly another income method that solves the problem of income method number 1 in the 2 structures we were looking at on Ollie. I'm going to show you another income method that might reduce the risk faster under the right conditions. All right, so let's go ahead and pause the screen, and I'm going to navigate over to power options. All right, there we go. My apologies. And let's go back to our screen. All right. So what we're looking at here is just the basic trial to power options. And remember, you can always take a trial. Just go to powerop.com and you can just put in your name and email address and you have full access to the tools for 14 days. Now, in addition to discussing the SIGA model for all 12 of the income methods, the blueprint, of course, also, first few chapters, discusses the proper structure and how to find new positions, how to find new married puts as a starting point. And it's fairly simple. If I'm on Power Options, I'll just go into the Married Put tool, and I'm just going to click on Search. The search tool in the 23 strategies we support scans across the universe of options and finds only those positions that match the default criteria. Now, there's only 3 potential trades we see right now that match the criteria we discuss in the blueprint. Let's just scroll down real quick. What do I want to see in my structure? Well, as we've learned before, I want to buy a stock and a put where the put is at least 5 months out in time to put time on my side properly. I want to control that risk to be between 3.5% to 9%. I don't want to go too deep in the money. That was described in the last webinar. I want a reasonable bid-ask spread. I don't want something too wide. But at the same time, I'm going to look for something that has a little bit of volatility, decent average stock volume, and I want to see stocks that are trading in an uptrend. Okay? We want to look for stocks that are trading above their 50-day moving average. That's just a basic default. That's why there's only 3 positions that are shown. There's a Cadence, Tractor Supply, and Ollie, as of the other day, were the only positions that were trading above their 50-day moving average. And for the basic fundamentals, we want to look for stocks trading between $9 and $200, good earnings per share growth, and we actually have a list criteria that we use that Ernie and I have been using for the past 10 years, and we actually check it on a regular basis, compare it to other stock lists to see how they performed with the RadioActive Trade, and we'll make adjustments if necessary. We haven't made any adjustments in several years because this has been working to our expectations and what we want to see with the RadioActive Trade. Now I'm going to take Cadence for now, and I'm going to take Cadence with the 46 put. I like this a little bit better. It's got a 6.4% risk on the position. The stock's at 44.56, May 46 strike put for about 460. But remember, the time value, 316, is the only risk on the position. All right, so say I decide to go with this position. What do I want to do? I go to the profit and loss chart. Here we are with our initial structure. Remember the risk of 6% roughly. If I get midpoint at 440, it's only even 6%. I still have infinite upside. Okay, so let's say I enter this trade. I buy the stock at 44.56. I have the 46 put, but I say I want to generate income right now. To control this risk, I want to start paying this 296 down as fast as possible. So what am I going to do? Well, I'd probably look to sell a call, right? Simple income method. Even if you're only at level 1 trading at your broker or level 2, you can buy stock, buy calls, buy puts, and sell a covered call. That's everything you need to do for RadioActive Trade and income method number 1, 2, 4, 6, 12, and 10 with just level 2 trading. Or if your broker at level 1 allows you to buy calls and puts, that allows you to do most of the income methods. But we want to do it right away. This just offers standard monthlies as Ollie did. It doesn't offer weeklies. But let's go to November. We've got the 45 at 105. Okay, that's pretty good. It's half of the initial at risk, just under half of the initial at risk, about 296. And of course the 46 at 65 to 80 cents or so. Well, let's sell the 45. Go ahead and sell that. We'll take the midpoint at 110. Thank you very much. And what have we got? Interesting. The risk didn't lower. It did lower to the downside. But if the stock gaps up, if there's earnings coming up and it goes to $50, $52 per share, we capped the gain too soon. We generated a good premium to cut that risk down to maybe only 195 to the downside. But again, we've capped it to the upside. And with the stock at 45, roughly, if my expectation was the stock's going to move up 5% in the next 20 to 40 days, it'd be about 250. We'd be here at about 47.50, right near the break even. This is not the structure I want to see. Yes, I generated income. Yes, I lowered the cost basis on the position. I didn't increase my risk in this case, but it kept the same in the direction I thought the stock was going to move. And even if the stock stays just at 45, remember my expectation was to be closer to 47, but if the stock stays right at 45, we'll make about 2.5%. That's not great, but I think I can do a little bit better. So let's go ahead now and take a look. What about that 46? That's at or equal to the put strike price for November. It's going to generate less premium, but at 65.70 cents, remember, so here we are, 65 to 80 bid-ask spread, midpoint around 72, 73 cents roughly. That does represent about a third of my total risk. Remember, the initial risk was about 286 or so at midpoint. 75 cents is a little bit below that, what I'd want to see for a third, but let's go ahead and sell that. See, now we've only increased it to 2.8%. My upper break even did move up to 49.72, but I still have an upper and a lower break even at this point. Generated income a little bit. The maximum risk was reduced, as was the cost basis and the potential here. But again, if my expectation when I opened this trade was that this stock had the potential to be trading around 47.5, up about 4 or 5% from the initial purchase price, is this the structure I want? Do I want to be here? No. Probably rather just leave it open at this time with the standard married put position. You know, we saw the max profit of around 2.8% and 2.5%, around $115 or so, with both of those income method number ones done too soon. But if my expectations are met, and at November expiration, stock's trading at 47.50, it's at 11.16, just staying in the married put by itself, I expect some decay on the put, but leaving the upside open, I'd have more of a profit if my expectations are met than trying to force this income method right now or forcing the income method too soon. Now, is there a way to still generate some decent income but leave the upside open? Well, there is. That's another income method. We might not want to do it right away because, again, of the structure. So what's part of the problem other than selling the call too soon? Other than selling it below the put strike price and other than trading against ourselves, because we're giving ourselves two ways to lose and we were expecting the stock to move up 4, 5, or 6% when it was open, but we capped the gain. So how can we solve that? If I sold that 46, let's go back to that there. It gave us the best structure, but neither structure is correct. Let's say I sell that 46 for the midpoint now to probably be around 68 cents or so. But at the same time, I buy a 48 call for 25. Now that's going to reduce the credit I'm seeing, and not really the credit I want. I'm going to want much higher than that. Let's go ahead and sell that 46 right away. And let's buy this 48 call. So 68 to 25. What is that structure by itself? Well, it's a bear call credit spread where we sold the 46 and bought the 48. And we generated a net premium of around 43 cents. Okay, so that's a good bear call credit spread, but in this case I'd want the stock to remain below 46 so that both calls would expire worthless and I'd keep the net credit. But in the structure of owning the stock that's already protected by the proper put structure, what do we get? We get a position that still offers unlimited upside, generates a little bit of credit to reduce the risk down to 5.2%. How is that possible when we had just a standard married put position that was bullish? We added a bear call spread that was bearish. How do we still have infinite upside? Well, think about it this way. Your broker might just look at this as that standard collar position we just saw, but now with an extra long call that you received at a credit that continues to move up. If the stock goes to 52, what happens to the position? Well, we do lose on the put. That's going to decline. The short call is in the money, as is the long call. So at expiration, if I did nothing, I get assigned at the 46. My broker might buy shares of stock at me for 48, so I lose $2, but I gained 43 cents. I'm sorry, 43 cents, so that's still $1.57. That's a loss, but the stock moved up from 45 to 52, plus 7. Or you could look at it as you got assigned at 46 and you bought stock at 48 that's now trading at 42. The numbers still work out the same. You do lose on that bear call spread in this case. In this zone, that's why it's declining from the peak. But as it continues up, you still have unlimited upside. You've still generated income to lower the cost basis and lower the risk. And you still have a controlled position if the stock falls in the other direction, in which case both calls would expire worthless. That's income method number 6. That's another one of the income methods that sort of solves the problem of income method number 1. But I still wouldn't do this right away. Why not? Remember, my target price was about here, up about 4 or 5% from the purchase price around $44.50 or $45. This isn't bad. It didn't enter into a loss zone, but we already saw that if I just left the position alone, gave it time, and it does meet my expectations, I'm going to be at a much higher profit. And then, if the stock's at 47, what can I do? I could sell the 48 call. I could sell the 48 call and buy a 50, probably get a better net premium, but have a position that had more upside and still the infinite goals. So this is just a warning about what we can do wrong with the income methods, why they're not done right away, and what we want to achieve with doing the income methods. Okay? Now, we showed you income method number 1. I gave you some rules of thumb. Here's an example of income method number 6, another income method that solves the problem of income method number 1 with capping the gain. Here we still have our upside open, but you want it done in a proper structure so you don't go negative here. A lot of times I'll see income method number 6 is done too soon, where you go back into the loss. And that's a problem because this is probably the profit zone or the likely place where the stock's going to be trading in the next 20 to 40 days. Why put yourself in a structure that could result in a loss to collect 40, 30, or 50 cents? Wait to see what happens next. And if the stock meets your expectations, you'll be much better off to apply one of the income methods following the rules in the blueprint. Now I'm going to navigate over the portfolio tools now and take a look at some of our examples that we saw. See, here's that Ollie position. I just want to review this very quickly. The first one here that Ernie actually entered with the 90 put. Hey, wow, good move today. The stock's at 92.07. It moved up since we started, and it's up 5%. This is Ernie's actual trade. His actual numbers with stock at 87.72. Buying the 90 put for 950. The stock's up 5% to 92, but he's only lost $1.90 on the put. Remember, the put just doesn't go to 0 if the stock moves up. He still has 170 days of time value with a roughly at-the-money put. The put's at 760, and it's out of the money now, isn't it? Let's take a look at the graph. The midpoint put price is at 760 on that Ollie trade we were looking at with the properly structured 90 put. 7.4%. When Ernie entered this trade, he paid $9.50 for the put when the stock was at 87.72. but it's a 90 put, so we've got $2.28 of intrinsic value. We're guaranteed to get that back. Of that 950, only 722 was the time premium, the extrinsic value. That's the true risk. What is very, very interesting about that we just saw? Ernie's been in the trade for 4 days. The stock has moved up, and yes, he's lost $1.90 on the put, but where is that 90 put now? And this is not an unreasonable bid-ask spread. The bid's at 730, the ask is at 760. How did the extrinsic value increase from 722 as time went on? We've gone 4 days. We should have 4 days of time decay. How has the put extrinsic value actually increased? And that's because of one of the 3 core principles of radioactive trading, the ATM bell curve. At any given time, you look at an option chain, the highest time value is always going to exist at the option that is at the money. When Ernie entered this position, his put was in the money. Stock was at 87, put was at 90. But now the stock has moved up, so Ernie's on this side of the ATM bell curve, where if there's a 92.50 right now, it would have the highest time premium. So it's not a lot of premium that's been gained. But has he lost money on the put? Well, he's lost $1.90 to gain $4 on the stock. That's a fair trade-off, don't you think? But this put is still retaining a lot of value. Why is that important? Because one of my favorite income methods to do when the stock moves in the right direction, at the proper time, following the rules in the blueprint, this is not just an insurance policy. The put is a second asset that I can manipulate to reduce the risk and put myself in a better position. So what can I do now? I'm going to take advantage of that time value. I'm going to take advantage of that extrinsic value increase, and I'm going to sell the 90 put for 760, and I'm going to buy the 95 for about 1040. So I'm going to pay about $3. This doesn't sound like an income method, does it? I'm paying a debit. All right, 760 to 1030, so it's actually 270. That's fantastic. I'm paying a debit of 270, which increases my cost basis. Why would I do that? Because in this case, I'm paying 270, 760 to 1030, to gain 5 points on the position. I have a lower risk now of only 4.9%. I'm down to 492. And remember, this is with the 90 put, where we started with a risk of 722. But I paid a debit to get into this position to increase the guaranteed payout by much higher. So I reduced the risk by that difference. That's income method number 4. Just showing you an example of 3 of the income methods. But again, when and why would you do this? That's discussed in the SIGA model for each income method in the blueprint. By the way, just because I moved up this put doesn't mean I can't do something else. Where are we now? Well, I've rolled up my put. I've got a new risk of 4.9% of 492, which we would have had roughly with the 95 put from the beginning. But why not reward myself, pay for some of that debit, and now sell the 95 call for 210. So I paid 270 to gain 5 points. I can sell the call now and gain about 210 back. So I'm really only paying 60 cents to gain a 5-point higher guaranteed exit. Oh, no, I'm sorry. I got to sell that call, don't I? Sorry, ladies and gentlemen. Here we go. Now I've got a risk of only 2.9%. 4 days, combining income methods. There's a full chapter in the blueprint on combining income methods. Reduce the risk down to less than 3%. Still have a maximum profit here at the peak of 5.9%. And look, it doesn't go negative again because it was done at the proper time. And even though I increased the put strike price, I'm selling the right call, following the rules for income method number 1. We took the risk down from, could potentially take the risk down from 7.5% down to below 3%. still have potential max 6% profit, but if it stays below 95 and this call expires worthless, we can just sell it again, and now we could take that risk almost bulletproof. We get another $2 for selling the December call at 95 or maybe 100 at that time, depending where the stock is. You might be able to cancel all of the risk and have a no-risk position. Is this idea of bulletproofing possible? Yes. Ernie and I do it with about a third of our radioactive trades, maybe a little bit more than that, over the course of each year, and Fusion subscribers see that on a regular basis. But this is what's possible with the income methods, not only individually, but also combining income methods. Here we did a 4 and a 1. I could buy the 100 and leave the upside open too if I wanted to, and that would put the risk at about 3.5% because I'd take some away from this premium. But it's a better structure, done correctly, following the rules in the blueprint. This is Ernie's trade. I don't know what he's going to do with it. That's going to match his individual SIGA model, but he's going to follow the rules in the blueprint. But this is showing an idea of what could be done and what is possible. I want to show you two more things in the portfolio. Just for grins, what I did here is, here's Ernie's trade we just looked at and what's possible with his adjustments right now. Here's the 95 put. We're going to ignore that. Here is my actual trade on Ollie, where it stands right now, that I got into a few months ago with a cost basis of 76.70. I'm actually just holding the 85 put on Ollie right now, and I sold the 95 call for 120. That was back on September 21st. Oh, I'm sorry. No, this was October. This was October 21st when I sold the 95 call. I apologize. That's not September. But the last adjustment I made when I rolled up the put was rolled up to the 85 put on September 4th. You can see that in the Fusion track record, or the open positions. But as a whole, where does this position stand right now? After other adjustments from the original cost basis, starting with an 80 put, rolling up to the 85, doing other income methods against it, I'm currently in a position where if it's right at 95, a November expiration will make about 20%. And I'm guaranteed a profit of 4.7% to the downside. Ollie could drop to $50 per share. I'm still guaranteed a profit because of the structure and the cost basis and following the rules in the blueprint. I could adjust the put right now. This 85 put, deeper out of the money and shorter term, because it was done at a different time, I bought at 565. But again, it's not at 0. It's still at 360. When I did this trade, the stock was at $86. So I've gained $6 on the stock to lose $1.20 on the put, roughly. But could I do the same thing that Ernie could do right now? Yes, I could sell that 85 put, and I could buy the 95. Once again, we could do that income method number 4 position. Oh, I'm sorry, I got to add the 85 put back in, sorry. So what do? I sell the 85 put. It's not at 0. It still has value. We pay a debit of $4.25 to gain 10 points on the position, to gain a guaranteed exit of 10 points higher. I did add to the cost basis here, but now I'm a guaranteed profit of 11.2% to the downside, still can make a peak of 18%. And even if the stock gaps up to 110, I'm still at a profit of around 10% on the position, a little bit higher. That's what's possible with these techniques. That's what's possible with the radioactive trading structure if you follow the rules in the blueprint to follow the income methods correctly. I'm not going to teach you everything about the income methods on our free webinars, but how would you like to be in this structure? Or even this structure at the beginning of October, right before the market fell, and Ollie's coming back up. Looks like a lot of things are, but Ollie's coming back up in price. And it's still a proper structure, and I wasn't worried about what was happening in October. I wasn't worried about the decline because I generated premium, but more importantly, I couldn't lose on this trade. It could go to $1 per share, and I'm long stock, and I could still make $385. Sometimes we like to brag about our losers here. Another real quick position that I showed you, here's one that I did open at the peak, beginning of October. Penn National Gaming, bought the stock at $33 per share. Bought the April 35 put, had 198 days to expiration for $420. The stock is down 33%, even with the market coming back up. It's down 30%. It was down about 32% at the beginning of the day. Here we are down at 30%, and I am at the max loss of about 5.2%. But what if I had done a covered call? What if I had done a bull put credit spread? What if I had done a calendar spread? My loss would be immense. 28% for the covered call, about 55 to 65% for the calendar spread, and the bull put at the time of the stock at 33 would be at full loss right now, 100% of what I invested. I'm only down 5.2% on the position. So that's a proper structure. And that's what RadioActive Trading can do for you, even looking at a month like October. And there are ways to profit in addition to that. Other ways to manage the position, I should say, in addition to that. Okay, so my apologies. That's the role of the income methods. That is why there are 12, because there are different market conditions. Different income methods work best under certain market conditions and based on your expectations. But even with what I showed you today, there's still ways to do income method number 4, just maneuvering the put wrong. If you do it incorrectly, you could hedge yourself out of the position too much. You might be able to see an opportunity to bulletproof it, but if you do it incorrectly, then you're going to end up in a position where even if the stock continues to move up, you're not seeing any more profit to the upside. You're hedged out too much. Now, there are really 13 income methods. If nothing looks good, looking at the profit and loss chart, always evaluate the risk-reward profile on the profit and loss chart before doing an income method, then do nothing. That to me is income method 13. Do nothing, wait for a better opportunity. But all the full description of the do's and the don'ts, when to use one over the other, or even combining income methods, that's a full chapter, is available in the blueprint. And so if you want to put this to work for you in your portfolio now, you want to control risk, and you want to get the SIGA model and the full description of when, how, and how not to use the 12 income methods to keep yourself out of trouble, go to radioactivetrading.com/iridium. There's a special link we're giving to you in the webinar today, and if you pick up the blueprint, you'll also receive these 5 bonuses here. You'll get a free month of power options that we just saw. You'll have access to the married put search for finding new married put trades. You'll get that first month of Fusion where you can follow Ernie's and my trades, usually $69 per month, but you get your first month for only $10. We'll send you a quick start guide to help you get started with radioactive trading techniques faster as you're going through the blueprint. It's a $50 value. We've also put together 6 Mastery Series videos showcasing some of the different income methods, management techniques of the income methods, and more, but you'll get the first one for free. It's an $89 value, and it's called The Foundations of Radioactive Trading. And of course, anyone who picks up the blueprint, you immediately get a full hour coaching session or conversation with myself or Ernie, and that's about a $100 value as well. Now, mentioned about bragging about the losers. I showed that Penn position that dropped 30%, and I'm at a max risk now of 5.2%. That's if I did nothing. Following the rules in the blueprint and the income methods that are available, with Penn down 32%, this is the profit and loss chart of the real radioactive trade that's in the Fusion portfolio. As of October 5th, taking a look at what we do for some of the income methods, we noticed a change in the stock and it wasn't doing what we wanted, so we did a different income method and created this profit and loss chart. Now, I'm still long the stock that's down 32%, but I'm at a liquidation profit right now of about 10.6, 10.7%, almost 11% on this position. Being long stock, protected initially so I couldn't lose more than 5%, Stock's down 30%, but following the rules in the blueprint, I'm at a profit of 10%, and I can manipulate this structure so that when earnings come out in 8 days, I can have a guaranteed bulletproof position of 9% with unlimited upside profit potential if pen gaps due to the earnings coming out on November 8th, I believe. That is the power of radioactive trading, that even when you're wrong, there are income methods that can put you in the structure, lower your risk even if the stock's falling. There's adjustments where you can lower the risk even if the stock goes down. So maybe you don't take that 6% risk, you only take a 3% risk. If you take a 3% loss, guess what? You only need a 3.5% gain to get back to break even. Whereas if I was in this as a covered call and this was at a 28% loss, if I take a 28% loss on a position, I need about a 35-36% gain to get back to break even on what I have left. Which is more likely to happen? A gain of 3 or 4% on your next trade, or a gain of 35, 36, or 37% on your next trade? That just illustrates the power of controlling risk. This graph illustrates the power of owning the blueprint and using the radioactive trading techniques for the different market conditions. So what's next for you? Well, you can wait for the archive to be posted. It'll be posted around 4 o'clock this evening. We'll send everyone an email when our recording is available so you can review it. You can go to that link, radioactivetrading.com/iridium, pick up the blueprint today, take advantage of those 5 bonuses when you're ready. You don't have to start that free 30 days of power options right away. You don't have to start that first month of Fusion for $10 right away. You can take your time and then activate those when you're ready. But you can start seeing how to control risk today to avoid another October scenario in your portfolio. And hey, if you think the market has bottomed and we've seen a lot of things been moving back up since we started the webinar, that's great. This shows you how to properly enter a structure where you've still got unlimited upside profit potential, controlled risk for any volatility that comes up, say with something in 7 days, 8 days. Might be a lot of volatility at that time leading into that little thing called the election. I hope you all go out and vote. But if things go up and down, we've seen the Dow go down 600 points, then come back up 200, then go down 300, then come back up 400, then down 500. When you're long that bumpy ride, I wasn't too worried about it because I knew exactly where I stood in each and every structure. I knew the worst case scenario is that I could lose 4 or 5%. Or the worst case scenario is I could make almost 5% on Ollie, even if it continued to move down or crash. Another black swan event occurs inside this little bumpy ride, I'm still comfortable. And with Penn, well, we already saw that structure where I am right now. And of course, you can still trade other strategies as you're doing right now inside that nested structure. I showed you a bear call credit spread, income method number 6. If you're just selling covered calls, this is a way to do it with the proper risk controlled and still being able to generate income on a monthly or weekly basis. Tom had asked, can you use weekly options? Yes, you can, if it matches the rules. Don't force the sale of a weekly option just because it's available, because we showed already how that could put you in the wrong structure. If you sell it too soon, at the wrong strike price, and for too little premium, you could end up losing as the stock moves up because it's not done the proper way. But you can use weekly options if it matches the SIGA model and the rules in the blueprint. Now, of course, if you have questions, send me an email at any time to support@radioactivetrading.com. You could also call us during market hours at 302-992-7971. As of course, there's contact links at the bottom of every page at Power Options or at RadioActiveTrading.com. But remember, most of the questions that you might have about the proper limiter structure, the income methods, how and when to use them, what is or what isn't an income method, that's really answered in the blueprint. We won't give you all of that information over the phone. But remember, if you pick up the blueprint using that link, radioactivetrading.com/iridium, you'll get advantage of those 5 bonuses, where the total value of those 5 bonuses is pretty much almost equal to the cost of the blueprint itself. And think of where you'd be, what your October might have looked at had you limited risk to only 4 or 5% to begin with at the beginning of October on your new positions, or if you had a structure that you could see that would allow you to benefit in both directions would you have had a better October than what you experienced in the last 20 days to date? Well, think about that when you're thinking about the blueprint. But remember, radioactivetrading.com/iridium. Take advantage of those bonuses. And if you have any other questions, just please send us an email or give us a call. Ladies and gentlemen, I want to thank you for joining me today. I hope you got some useful insight as to the role of the income methods and the risks of trying to do it potentially on your own and putting it in the wrong structure. I hope to hear from you soon, and I hope to see you soon again. We'll have other webinars coming out here as well. Sean, I'll send you a personal email. Sean commented, I purchased the blueprint some 5 years ago. Is it still the same? We always do enhancements to the blueprint, add extra material perhaps, clarify certain things that are in the discussion of the income methods in the various chapters, add new chapters. To answer your question, Sean, we are at an updated edition. I believe we're at edition 14 of the blueprint right now. But anyone who has purchased the blueprint in the past, you'll be able to go on to radioactivetrading.com and you'll be able to access the PDF documents for the updates that we made from your blueprint to the most recent one. So I'll send you an email in the next few minutes where you can go to radioactivetrading.com. I'll tell you where to go on the page as a blueprint owner, and then you'll be able to see the PDFs there and just download those, print them out, put them in your blueprint, and you'll have all the updates that we've done in the last 5 years from your edition to the current edition of the blueprint. All right. Well, ladies and gentlemen, thank you again. Have a great trading week. We'll let you know of other webinars coming up for education on radioactive trading and various other strategies and the tools on power options. And most importantly, I'll send you an email when this recording has been converted, posted, and available in the archives. Take care, everyone. And of course, if I don't see you before Wednesday or hear from you before Wednesday, have a happy Halloween. We'll see you soon. Good night.